Good afternoon. My name is Eric Levinson, Head of Business Development for VinaCapital, and welcome to our 2022 Mid-Year Review and Outlook. I'm joined today by our Chief Economist, Michael Kokolari, and Ismail Pili, our Head of Research. And this afternoon, we're going to walk through what happened the first 6 months and then really turn the focus to what our views are for the 6 months ahead. Now, before we do that, I think it's important that we give ourselves a little bit of a report card and look back to our forecast from January. What did we get right? What did we miss? What did we get wrong? And so we'll take a look here at our first forecast from the beginning of the year. What did we get right? Well, we did forecast strong GDP growth. We were correct there. We did forecast really a very low and manageable level of inflation, which certainly is true in Vietnam. Vietnam has continued to have strong FDI flows. We've had very, very strong domestic consumption, and we also forecasted higher volatility amidst heightened risks. Now, we gave ourselves kind of a yellow light, kind of a neutral for lower exports to the U.S. They have lowered, but they're still quite strong, as we'll see. Now, what did we get wrong? Well, we did forecast a strong stock market for 2022. Now, I will say this is an incomplete grade because it's mid-year, but certainly given the performance year to date, that would be a red X. And we also forecasted strong performance for financials and real estate, and that's really what's dragged down the market. Now, what did we not forecast? So we talked about what we got right and what we didn't get right. Here's the things that really have weighed on the markets globally and within Vietnam. First and foremost, Russia-Ukraine. We did not predict that. I think it would have been hard for anybody to do so. And then certainly the spillover effects of that. The second thing, which was kind of an unknown, was the very aggressive U.S. Fed rate interest hikes and what that has been in terms of the impact around the world. Third, kind of a global resurgence of COVID in China and the resulting shutdowns and supply chain disruptions. Now, we think the bulk of that is behind us, but that certainly impacted markets globally. And then within Vietnam, there were a couple of factors that really weighed on the markets. Number one was the investigations into FLC and Tan Hoang Minh, THM, and those one on the equity side, one on the fixed income side. We also saw a slowdown concerns about lending to the real estate sector, and that really was based on the two things we just talked about. And then third, and again, these are related, a drop in market liquidity within Vietnam. And so as we think about what we didn't forecast, those last three really impacted the Vietnam market, and Ismail will certainly speak to that. Now, having said that, I think it is important that we take a look at our performance. How did we do? Well, for our offshore funds, VVF, which is our daily liquid usage portfolio, VAF, which is our monthly liquid Cayman feeder fund, actually incredibly well. Now, no one's going to be wildly excited with negative performance, but our year-to-date return through June, VVF down 7.8 versus down 21.6 in US dollar terms, 1 year up 50 basis points versus down almost 16, 3 year up 18.5 versus 8, and 5 year up 11.3 versus 8.5. VAF, similar performance. In fact, even a little bit better. You get that illiquidity premium, a 3 year number up 20.6 versus 8. And so you see that our offshore funds, we've delivered benchmark beating returns. And if you look at our peers, we're doing very, very well versus our peers also. And this extends to our local funds. So if people are here in Vietnam or looking at our local funds, our outperformance versus the benchmark and versus our peers is across our entire equity platform. So VEOF and VSAF have very similar performances. These are actually in VND terms. So again, down 6.7 versus 20.1 or 6.8. But again, 1 year, 3 year, 5 year, the outperformance is quite impressive. So as we think about VinaCapital and our obligation, our responsibility to our shareholders, obviously the market down roughly 20% year to date. That's not attractive, but certainly we've been able to navigate these markets extremely well. And as we'll hear from Michael and Ismail, we continue to be cautiously optimistic about not only the economy, but importantly the stock market. So if you've held with us for the first 6 months or you've been evaluating whether or not to add Vietnam to your portfolios, hopefully you're listening at a very good time. With that, I'm going to turn it over to Michael. Michael, I think the cliche is, may you live in interesting times. 2020 was the introduction of COVID. 2021 was the lockdowns. In 2022, Russia, Ukraine, potential global inflation scares. There's kind of a new risk that's coming up, and I'll end with the question, the old cliche years ago, and I think it's important to introduce to you and to Ismail, the old cliche was the U.S. sneezes, the rest of the world catches a cold. We've seen that from a market perspective. Are we seeing that from an economic perspective?
The short answer is no, and we're going to talk about that. The big news in Vietnam is that we had a blowout quarter in Q2. GDP growth almost 8% year on year. This is the fastest quarterly growth rate in Vietnam in over a decade. And it's being driven by domestic consumption. As Eric mentioned and we showed in our scorecard, this is something we predicted at the very beginning of the year. And those of you that saw the Q1 webinar may remember that we were talking about a lot of anecdotal evidence, all the things that we were seeing around us. During Q2, in the research team, we had the chance to really go deeper into this and do a lot more bottoms-up look and channel checks and go out to the periphery districts of the big cities, go out to the countryside. And what we see is that this domestic consumption story is extremely strong, and we see it everywhere. So very strong domestic growth driving high GDP growth. And in Q3, what we're going to see, and this is what I've highlighted on the slide here, is the year-on-year GDP growth in Q3 will certainly be higher than in Q2 because, as Eric just mentioned, last year in Q3 was when we had the worst of the COVID lockdown times. So this is something economists would call base effects or favorable comps, comparables. And you can see on the screen here, I've highlighted that last year in Q3, the economy was terrible, and domestic consumption, I just mentioned, is going to stay really strong. And so that means we're going to have a very strong Q3. I think, and I'm getting a little bit into Ismail, I'll leave this to you mainly, but I think what's going to happen is that the Q3 GDP number is going to be so strong and it's going to catch the attention of CNBC and Wall Street Journal, all this kind of stuff, and that will prompt money to flow into the stock market here, especially China's stock market will probably be doing very well at the time, but this is more your area. So that is what I expect. We now, as you can see on this slide, expect GDP growth of over 7.5% this year, of 7.5%, and I'm not surprised if it comes over. And we start to see now some of our peers that we have a high respect for actually predicting GDP growth of above 7.5%. Now, at the beginning of 2022, I had really the very highest GDP growth forecast in the local industry here. People thought we were a little bit crazy about how high our number was. And now what you see is other people are actually starting to be above what we're predicting. We like to keep these webinars sort of short and punchy. I could spend 40 minutes talking about all the favorable things in the economy.
Please don't.
And I won't. But I've highlighted one of them on the slide here, and maybe it will come up in the questions. But I've highlighted one of them on the slide here is that we have continued very strong FDI inflows. Many other things we could talk about. But as I just mentioned, the really impressive story in Vietnam is this domestic consumption story. And you can see on the slide here, looking at the level of retail sales, these are just raw numbers, no inflation adjustment or anything like that, that every month the year-on-year figure is just getting, going up in a parabolic, basically. In June, 27% year-on-year retail sales growth in Vietnam. In Vietnam, this is a fast-growing economy, so this number is always big. But even for Vietnam, this is like really, really blowout number. So this is what the positive story. Now, to get back to the point that Eric alluded to and opened with, the only thing we're really a bit concerned about is this slowdown in the U.S. economy that's happening now. At the beginning of 2022, we made two very non-consensus forecasts. The first is that Vietnam would be much stronger than what people expect. And the second is that the U.S. would not be that strong. Now, we're not U.S. economists, but we leave that to people who are smarter than we are. But we need to pay attention to that because, as you can see on this slide, the U.S. is our biggest export market. So in the beginning of this year, when you saw on CNBC and people were talking about, oh, the U.S. is so strong, and I mean, we didn't believe any of that, and we said that in our webinars, and that prediction has turned out to be true. You can see on this slide that the demand for big ticket items that are made in Vietnam. So we're talking about things like furniture, televisions. The demand for these kind of things is really falling off the cliff. Why am I mentioning that? I'm mentioning that because I just told you that we're expecting 7.5% GDP growth, or maybe even more. So the point that I really want to emphasize right now is our prediction is not predicated on what's happening in the rest of the world. This is a question that comes up very often. You know, people will hear from investors say, well, how can you be so optimistic when, you know, everything's falling apart in the rest of the world, as we predicted, by the way. And what I want to emphasize here is that we anticipated that, and we had already put that into our forecast. Exports to the U.S. are still up about 20% this year. It's a big decline from last year when it was up almost 50%. I think by the end of the year, we'll still be up about 10% or so. But we factored all this into our analysis. Another thing people are concerned about, as Eric alluded to in the opening, is the level of inflation in the world. Now, perhaps this week a little bit less concerned with oil prices crashing back down to 120. We actually think oil price will be back up to 120, perhaps even 130 by the end of the year. Again, we're not oil analysts, we're not, you know, U.S. economists, but so given that is how our thinking is, what I did is I made a bunch of different scenarios, what you can see on the slides here, and the key point here is that in every scenario, basically, inflation ends up to be something like 4.5% at the end of the year. The key point here, which is a really important point, is inflation in Vietnam will remain within the central bank's range of acceptable range. So we do not expect any.
What is that?
Well, the central bank looks at the average rate, and they want it to be below 4%. And you can see on the slide here, we're expecting the average to be around 3, maybe even less than 3% this year. So every other country in this region is hiking policy rates. You know, Indonesia, Thailand, Malaysia, Philippines. And so what I want to say really clearly right now is no interest rate hike in Vietnam. And part of the reason why, part of it is this well-controlled inflation story, but the other reason why we don't expect a rate hike is that the dong has remained very resilient this year. Now, I've cheated a little bit on this slide, and I've actually recycled the slide that we used in our Q1 webinar. And what this slide was about was that we were predicting at the beginning of the year that the dong would be quite resilient if the Fed aggressively hiked interest rates, and that prediction also really came to be true.
You said the dong would strengthen, just to be clear.
Okay, it hasn't strengthened, but given a 10% increase in the value of the dollar as measured by the DXY index, we've only depreciated by 2%, you know, which is a much better performance than our regional peers. And the resilience comes from the fact that the FX reserves are ample. The level of US dollar denominated debt in Vietnam, both corporate debt and government debt, quite reasonable. We have, you know, we still have a trade surplus. We have lots of money coming in FDI, lots of money coming in. Remittances will probably be 5 to 6% of GDP. So it's a very healthy picture for the currency. And the last thing I want to mention is something that we also get a lot of investors' questions about is, you know, what about this whole slowdown in China? Last week we have now another Chinese property company that's, you know, eventually defaulted on its debt. So what I want to remind investors, which is a topic that we've talked about in some of our reports before and some of our other webinars, is that Vietnam has very minimal exposure to China's domestic economy. Okay? The way to think about the interaction between Vietnam and China is that we import a lot of production materials, a lot of intermediate goods, a lot of factory equipment. So we need all that, and what we do is we then fashion those intermediate goods into final products that we then sell to the US. So the way I like to explain it is, you know, Vietnam is kind of like a customer of China, and the US is our customer. So, you know, we're not so concerned if China's economy slows down. I could talk more about that in the Q&A if anyone's interested, but we're not so concerned about that, but we're very concerned about what happens if there's a slowdown in the US. But again, I factored that in. So the key point is we're really expecting a blowout quarter in Q3. We're going to have very high GDP growth, and that I think will really set us up nice for the stock market. So that's the right time to turn it over to Ismail then.
Yeah, so, you know, Michael, thank you so much for painting, what is it, a positive picture. And you know, we've gotten some questions you know, being in Vietnam, are we overly optimistic? Because I think right now, you know, you're going to say, you know, everything we've said in the first quarter, second quarter, you know, you just heard it's the beginning of July, and you would think, based on your comments, the market, which was up 37% last year, would be up 20% this year, and it's actually down 20% this year.
While we were under optimistic, it's been much better than what we had expected on the economy. Yeah.
So the question to you is, okay, so we've got a blowout quarter GDP growth. We have what looks to be a very optimistic economic outlook, including domestic consumption. Why is the market down 20%?
Right.
And we can cover that a little bit, but importantly, for folks that haven't invested in Vietnam yet, what is the outlook from your perspective and the research team perspective on the next 6 months?
Sure. So on the back of 2 fantastic years where in 2020, the VNI rose 15%, and then in 2021, another 36%, we were actually quite cautious. We had a note internally saying that we're probably looking at heightened risk and volatility would probably have to be escalated. And the reason behind that, first and foremost, is the fact that the Fed is pivoting or has pivoted towards a tighter monetary type of policy. As Eric alluded to, what happens in the US tends to have a spillover effect in global equity markets, and we didn't think we were going to be immune to that. What we did think, or what we expected, was we thought that maybe the domestic crowd that we had here would lend support to that pressure for the market to come off. And so despite the heightened volatility that we expected, we thought that maybe we would be trending a little bit higher. That, of course, did not happen. But I think the reason behind that was not necessarily related to the fundamentals that you just described, but it was really triggered by this anti-corruption wave that started in the end of March that carried on to April, and I guess we're still talking about it now. If you look at the performance of the VNI for the first quarter, we were actually flat Q and Q. All of the underperformance we've seen so far has been in the second quarter, and that was triggered by this anti-corruption wave that I mentioned. Now, mind you, people have been saying this is great for the long term, and would you agree with that? I think it's a transparency and governance issues that needs to be addressed because Vietnam has been accused of violating these things in the past. But if I look at the political and risk consultancy assessment as of 2021, Vietnam has actually moved up among Southeast Asian countries. It actually has the highest score. Only the North Asian countries are beating it, and yet this is not factoring in this current anti-corruption drive that we've seen. If you take a look at the value turnover, we're still running year-to-date at about $930 million. For 2021, it was $954 million. So we're not that far off in terms of ADT. But mind you, the first quarter was about $1.1 billion. It's really the second quarter where we were down to about $740 million. That's actually led to this number that we have year-to-date. Now, the most important thing is how attractive is the market? The market looks very attractive. It's cheap for those value players. It's got growth for those growth players. So whether you're GARP, whether you're value, whether you're focused simply on growth, Vietnam seems to offer that. In terms of context, let me put it in terms of numbers. We're looking at a PE of about 12 times right now for Ford 2022, and probably about 10 times, 11, depending who you're looking at for 2023. That's the cheapest in the region. In terms of growth, it has been trending down, and yet at 16%, that's still the highest in all of Asia. Only Indonesia has a higher number at the moment. But I would argue that the quality of earnings is actually quite good in Vietnam, and I would argue that they would probably have upside potential given what Mike has just painted with regards to the scenario for GDP. If I want to take a look in terms of performance, yes, we are down 20%, but because of the resilience of the VND, we're down 21%, 21.5 to be exact, in US dollar terms. And the markets are beating us right now. It's pretty much everything, but the ones that are worse are actually Korea, Taiwan, and Japan in US dollar terms. Our expectation is that it's not going to be a one-way ride towards a much higher index target that we have at the moment. As Mike alluded to, it's possible that we could still be 10% higher than what we ended, which is about 1498 in 2021. But how we're going to get there is not going to be now. We actually do expect further down legs in the US, and that will probably drag down the Vietnam market as well. But as the recession risk, if they transpire, as the stock market crash becomes more fearful for the people in the US, the Fed will have to stop their aggressive stance in terms of their tighter monetary policy. And that in itself will be the inflection point. The US will probably see a little bit of a rebound there. Mind you, every bear market accompanying recessions has averaged about 35% down market, but the rebound has tended to be stronger, 15 months, about 165% following that bear market. And that will probably drag the whole global equity markets higher. We are more optimistic on Vietnam. Asia can be argued that maybe China has a reopening play going through, but the structural story for Vietnam is extremely powerful in the sense that the demographic dividend that we continue to enjoy, the recovery of incomes, coming back to life, the wealth effect is less of a factor, despite the fact that we have 5.5 million accounts now. We are thinking that the consumption story continues to be played out, 2/3 of GDP. We see that in the numbers in terms of corporates. We actually do think that the numbers of 16% will be much higher, maybe in the 20+% range by the time this year is finished.
And thank you very much, Ismail, for your comments. And so as we think about it, I've got my app pad in front of me, so if you have any questions, please put them in the chat function. I see that a couple have come in, but this one's actually from me. So you talked about how earnings growth for the market consensus is 16%. Now, it's important for the audience here. We're an active manager. We're not buying the market. Most of our portfolios are very much high conviction, 25 to 30 companies. Our earnings growth, we just looked at VVF, our usage portfolio at roughly 40% earnings. And so as you think about 16% versus 40, what are those companies like that are the top 25 holdings that we have right now?
Well, this goes back to the way we look at the companies as far as research is concerned, I guess, as well as our fund managers. It's very bottom up. It's very fundamentally driven. It encompasses the quality management that we always seek out. And right now, we're probably a little bit more focused, or perhaps the fund managers are more focused on the reopening recovery play. We've seen this script play out in many markets where once you go through a reopening play, certain sectors tend to benefit, of which consumer discretionary tends to be one of them. Utilities is quite defensive, especially in this type of environment. And you might even say the IT, the sole IT company that we kind of have representing Vietnam. But those have done quite well. So I would attribute that to the bottom-up stock selection. It's not about sector picks.
So it's interesting, and a question just came in. Now we are underweight financials and underweight banks, which has been, certainly, one of the reasons for outperformance. Was that a bottom-up call? Was that a top-down call? And how do you think about that? What are the earnings like for the banks as well?
Sure. Well, as you saw in the report card earlier a few minutes ago, we got that one wrong. Mea culpa right there. But earnings tend to lead markets. And right now, what we've been looking at the banks is that the numbers are actually trending higher. It started about 30%, 35%, now it's about 40% for the consensus figures. So they actually do offer a great opportunity as far as growth is concerned. You're probably going to see higher margins, you're probably going to see lower provisions, and those are the two combinations that does well for any bank around the world. Mind you, it has not worked well, and I think that has more to do about sentiment and perhaps the overhang that we could attribute to since the third quarter when people start getting concerned about the potential asset quality pressure that might arise because of the real estate sector, either because of financing from the corporate bond market or perhaps because of these investigations as part of the anti-corruption drive that we've been seeing.
Yeah, so, again, I think it's a credit to the portfolio managers. It's not enough, and I think it's important to think about the way your research team works, the way our PMs work. You can have fantastic earnings growth, but that's just not enough to get in the portfolios.
That's right. Yeah.
Okay.
I mean, we have to be selective about the whole thing, and we have to identify certain themes that might actually serve as tailwinds for those stocks.
All right. So a question coming in here from Nigel. So this is going to you, Michael. Michael, given your predictions about the economy, is there a risk that it will overheat?
Yeah, that's a really good question. Basically, the way I'm thinking about it is that the slowdown in the global economy, which we expect, will kind of dampen that possibility. That having been said, I will say, and I kind of alluded to that before, I've seen some predictions for GDP growth this year from people that we respect, 8%, 9%. I mean, if that does unfold, that the U.S. doesn't slow as much as we're expecting, yeah, that is a risk. That would be a high-quality problem to have, but it would be a problem.
And it was I think the IMF just came up, said 6%, but that was an upgrade to what they had from the previous number.
The World Bank and the IMF and some local economists tend to be fairly pessimistic usually.
Okay. Yeah. All right. So Iz, back to you. Well, actually, this could go for either one of you, but we'll see. What about international investors? One of the questions, and we're obviously talking to a group of international investors here, but I guess the question is, will foreign funds come back to the market, or do you really think that people will wait until there's the MSCI upgrade to emerging? Which, by the way, just to be clear, we don't have any predictions on when that will happen either.
Actually, we talk about this a lot, so maybe I'll talk about the next 6 months, and then you talk about the longer. Look, I think that, and this was a call that we made. Again, we're not like global strategists or anything like that, but we internally called the rebound in China a while ago, 3-4 months ago. So I think part of what's going to happen is that this interest in China, and you've seen a couple weeks where you have like $5 billion type inflows into Chinese stock markets, part of that I think will overflow into interest in Vietnam. That's sort of the very, very short-term view, and then I leave it to you for the longer term.
Sure. I mean, even on the shorter side, the foreigners have actually been buying the market at this point in time. They've been sellers for the past 2 years. And one, joking aside, would say that the foreigners have gotten it wrong in the sense that they were net buying when there was 2018, and yet they were selling when the market was actually rising. And now they're buying when things are falling. So I'm not saying that they're counter indicators, but I think they do identify pretty good opportunities at the moment. Now, the selling might have been because of either asset allocation or opportunities elsewhere. So it's not really a true indicator of how they behave or how they look at the market. But I reckon the foreigners will probably have to find their way back here. It's just too attractive in Vietnam as far as the structural story. As Mike alluded to, this is a long runway when you talk about the demographic dividend, the modern retail, the low penetration in various sectors. And yet you look at the valuations being so cheap, never been cheap in such a long period of time, as well as the growth. As I mentioned earlier, only Indonesia seems to be offering higher growth, but I would continue to argue that the quality of the growth here in Vietnam is probably much better.
And then, so the other thing is, if we get a 10% plus print on Q3 GDP, I mean, that's going to be big news in CNBC, Wall Street Journal. That will attract a lot of attention too, I think.
And so, and another question came in kind of at the same time that was about less Vietnam, but more about kind of investors going back to Asia overall. So I think as people maybe even pivot to China, look what's going on in that market, there hopefully will be some spillover effect. Michael, a question came in getting back to the currency. Your take on the Vietnam currency versus Fed rising rates, strong U.S. dollar. We touched on it earlier. Do you think that, we talked about, does the SPV need to raise rates here for political reasons, or are there other things they can do to make sure the dong doesn't weaken?
Okay, this is getting a little bit into technical type things going on. Two things I would note. One is that recently the U.S. put Vietnam on the currency manipulator watch list. And this, contrary to what you might think when you first hear that, that will actually be a positive for the dong, because what happened last year is that the SPV was actually still acquiring a lot of FX reserves, and they were doing it, this is a bit of a geeky economics thing, but they were doing it what economists would call unsterilized, which means basically they buy the US dollars and they pay for those dollars with freshly printed dong. That has the effect of kind of dampening the value of the dong. And right now what they're doing is, number one, because of this getting put back on the currency manipulator watch list, and also because they want to strengthen the value of the dong, the central bank has actually been selling dollars and buying dong out of the market. They've probably bought about $12 billion so far this year. That, when you take dong out of the market, it actually has the effect of supporting the currency. So again, I don't think they're going to need to raise policy rates. I'll correct something I mentioned in passing before that came from my mind. I said that the average inflation rate would be below 3%. I meant to say below 4%. So as long as the average inflation rate is below 4%, as I had on my slide earlier, they won't raise policy rates. Yeah.
All right. Another question is coming in. Based on the comments, it sounds like potential upside is very much correlated to the U.S. and its financial market health. What about the local investor base? What factors can encourage more interest and support from Vietnamese investors?
You want to take this one first?
Well, one thing we can point out, what we both noticed, is local investors are very sophisticated about what's happening in the U.S. I mean, we get a lot of quite detailed questions about the number of Fed rate hikes expected this year, et cetera, et cetera. So I would say that those two things are kind of intertwined in my mind.
Yeah, the last data that we had for new account openings was over 470,000 new accounts. Now, whether that translates to more support to the market, we're not certain. But certainly, if we wanted to look at perhaps a possible roadmap as to what would get local investors back in, the second quarter results, or first half numbers, are about to come out. And I'm actually expecting much better numbers than people are expecting, particularly in the banking sector side. As I said, I do expect numbers to be trending up towards that 40% plus number year on year, even if the Q&Q is a little bit flattish. The second thing I would be looking for would be the resumption of the corporate bond issuance. They would have to probably start loosening up. And then in relation to that, the credit quota Now, the question is whether they're going to give that in August or September. The bottom line for us is they will have to give that at some point in time this year, because they will have to hit that 15% type of target for credit growth, because that is actually quite key for getting that GDP that they're kind of, for lack of a better word, managing to 6.5% to 7.5%. So I think all three of those factors I just mentioned can be used as tick marks or box ticking exercise to potentially see domestic investors come back in.
And actually, for Ismail, you touched on something in passing a few times now that I think people should really, really understand, which is that the asset quality issue is basically finished now. I mean, this is part of what the earnings growth story is, right?
Yeah, if you look at banking sectors around the world, the fact that GDP growth here could be 6.5% to 7.5% means it's quite a robust economic backdrop. And you rarely see asset quality pressures, or at least NPLs rising, in such a scenario. So I don't think that we should be anticipating AQ pressure. We should actually be thinking about provision releases. And as I mentioned, that's one of the key factors for the bottom lines for any bank around the world.
So you think it'll be, even fundamentals will actually drive the retail investors back into the market?
They would have to. It's too hard to ignore the whole idea that this is the biggest segment of the market at anywhere from 29 to 30+%, depending on the life of day. And yet it's offering also one of the strongest as a sector as a whole. So it's hard to ignore.
And I'll add one comment, which is quite small, but still I think if you think about sentiment, responsible for our local mutual fund business. And interestingly, we've actually been net positive every month this year. Now, I won't go into the numbers because they're small when we're talking about, versus Europe or versus America. But it was interesting to me that a lot of folks that were first-time investors in funds, what would they do when the market actually declined? And what we've seen, and it's been surprising to me, is that we actually receive more trades, more business from existing investors every month than we do from new investors. So I will tell you, it's been very heartening to see for the local business that we're not only seeing net positive flows, but we're seeing existing investors add to their positions. So hopefully that'll translate over into the individual stock side, or hopefully they'll buy more local funds.
What I'm impressed with is the number of very sophisticated questions we get from, literally almost taxi drivers, and people really asking about earnings growth, and they really know what's going on.
Here's a question, probably more for Is. What is the fastest growing subsector in the retail market, and how much do you estimate the retail sector in the next 5 years?
It's a very interesting question, because we do have this reopening play going on in Vietnam at the moment. If you look at the consumer discretionary, that's actually the fastest segment that's growing within that sub-segment of the consumer industry. If you look at certain names such as P&J, they're actually coming up with stronger numbers than what my analyst has been forecasting. And you look at something that has a little bit more on the staple side, and they're actually kind of slowing down. And this goes back to perhaps that slight inflation pressure that Mike was alluding to, that they're maybe watching, I guess their pennies, if you want to call it that. But on the higher end segment, of which P&J, the jewelry, and some other segments that actually caters to that higher end of the crowd, they're actually doing much better than what we expected.
Yeah. Another question, some really good questions are coming in. Can you comment on Vietnam from a valuation level perspective and put that in a historical context?
Sure. We're trading around 11.8, let's just say below 12 times. Historically speaking, if you look at the last 5 years, we've been trading about 16 times PE. If you look even longer term, 10 years, it's about 13 times. So whether it's a 5 or 10 year, we are certainly trading at a discount at the moment.
And again, Ismail, we're talking about consensus numbers. When I look at our active portfolios, we're trading at sub 10 with growth that's literally 3 times higher than consensus. And so we're in this disconnect where our top holdings are growing at 35, 40+% and trading at less than 10. And so, people ask us, we just to be clear, at VinaCapital, we're growth investors. It may not look at it because we just don't have to pay the high valuations. And so we're in a very unique time where we're growing very, very quickly. And in this case, the PEs haven't caught up. And then if you look at last year, the market was up 37. Our portfolios did better, but there wasn't a huge PE multiple expansion because earnings growth were so strong.
That's right. Again, going back to the market, not about our funds, which did much better. The market was up 36%, and the earnings growth was up 36%. Yeah. It goes back to the theory, earnings lead markets.
Now, a question came in, so maybe Pierre might have missed one of the questions, but is there, I guess the question is, you mentioned banking sector has a good outlook, so why are we underweight banks? And maybe make one comment on sentiment.
Yeah, the sentiment arose from, I guess, the end March anti-corruption drive there was also concerns about the corporate bond issuance, that some of these smaller developers, not the big ones, might have some financing problems which might lead to some distress. When we assess this, we realize that number one, the big ones are not of any concern. The smaller ones is not going to create a systemic risk, and also the asset quality pressures that people are anticipating is not going to be coming. Secondly, there's concern about banks withholding lending to certain segments, such as real estate. And yet, again, we checked the companies on both real estate and the bank side, and the SBV came out and supported the idea that, no, we are not telling people or the banks to restrict any lending to any segment, particularly on real estate. So I think it's just fake, I guess, not fake, maybe just wrong concerns. You know, you really have to be here on the ground to understand what's going on, because otherwise you see these headline concerns, and yet this is the advantage that we have. We had boots on the ground. We've been on the call every week since that thing happened, and we were quite confident that it wasn't going to be blowing up. But again, you could be right for the wrong reason, because the market did not see that yet, because they didn't have that information that we got.
Yeah, but having said that, being underweight in financials, being underweight in real estate has absolutely been the right decision. And I guess within our portfolios, the expectation is those underweights will probably close. And in conversations we had on Monday at the research meeting, it'll be individual names, not buying a basket.
That's right.
So we're always going to have preferred or our favorite stocks, not just hey, let's just take a big basket approach.
Well, Vietnam is not about picking sectors.
Yeah.
It's really about those stock selections.
All right. So a question just came in regarding tourism, and so we talked about this a bit. So I'll ask two questions. There's one from Tony. Have we seen signs of return of the Chinese tourists, which obviously was a huge percentage of overall tourism, and what could the impact of pent-up tourism to be? And let's talk about international tourists versus domestic tourists as well.
Right. Okay. So for Chinese tourists, no, zero. But in Chinese tourists, we're about 1/3 of the total tourist pre-COVID. But for the other countries, I mean, it's already exploding. We really see when you go to the hotel or restaurant, it's very, very busy. We think that probably foreign tourism will add 1 to 2 percentage points to Vietnam's GDP growth this year. And that's simply because pre-COVID, foreign tourism used to contribute about 10% of the economy. So, just sort of mathematically, something goes from 10% to 0, and then even when it recovers a bit, there's the delta on the GDP number is big. So that will be a significant contribution. We see around us everywhere, even in the resorts and whatnot, it's very busy. But Chinese, no, not yet.
Yeah. And also, I'm sorry.
I was going to add on the domestic side, the indications we've gotten, depending on which data set you're using, is it's 105 to 125% of pre-COVID levels already.
Yeah.
So if you fly domestically, my gosh, it's very busy.
Yeah. And particularly now, it's, I guess, schools are out, so the airports are nuts here. All right, a question just came in. What are our thoughts about stocks related to companies in the insurance industry? And are there many publicly traded securities in the insurance industry as well?
Yeah, it's a very small subsegment of the financial industry. If, let's say, 32% of the basket of financials, banks would account for 29 to 30% of that. The brokers would be the other non-bank financials, and then insurance. Insurance is actually the small portion of that basket, but they have done well because on the sentiment, on the idea that interest rates are rising, insurance companies just globally tend to do well on that notion because the investment yields tend to be better. But yeah, it's very tiny in terms of representation.
And here's a question that's come in, and this is we get this maybe twice a year. Is why isn't there not significant IPO activity in Vietnam? And any comments from either of you about potential privatizations?
Well, one thing we can say right away is that the infrastructure development is still kind of just bumbling along, probably up about 5 or 10% year on year this year, and that's despite the fact that the government had sort of made a big deal at the beginning of the year about having this fiscal stimulus package, and they were going to do all this infrastructure development, and it's still kind of bottleneck for this reason, that reason, whatever. I think that when you see a surge in infrastructure development, that's when you'll see the surge in IPOs, because they'll need to raise money to pay for that. And so far, we just don't see that.
It's also a carryover, the anti-corruption drive that started many years ago. Even though it's in the headlines at the moment, this has been going on for many years. In fact, people will argue for a decade. And there's issues also with regards to the land. The land law has not yet been passed. And of course, a lot of these companies may have state land that's in contention, and yet there's no clarity. So it's really tough to push through. No one wants to be the guy who's holding the bag that pushes through through a privatization, and yet there was some uncertainty still, especially on the land side.
Yeah. So again, just to answer the question more directly, we don't have kind of a 6-month rolling forward IPO calendar, so there's not a big syndication thing that's coming through. But we think we can generate excellent returns with candidly what is available today, and frankly, that is a smaller pool of companies to buy, which obviously can help. So another question come in, should we worry about, you talked about this, but just a question came in as well, so should we worry about inflation hitting domestic consumption as it can be seen in the US? So for a company like P&J, which is really focused on the domestic consumer.
This is a great question. Actually, in the very beginning of the year, we were forecasting 7.5% GDP growth, and then we had the Russia blah 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 stuff, and oil prices went up, and we did a bunch of calculations, and we sort of calculated how much domestic consumption would be siphoned off, by people having to pay higher, petrol bills for their motorbike and this kind of stuff. And what we found is that we were not optimistic enough about how resilient consumption is. So I think unless we really get to like oil over 130, 150, something like that, what we've seen so far is that it doesn't have much impact. We were really too pessimistic about how inflation would impact domestic consumption, and it just hasn't had the impact that we were worried about. So
yeah, actually, you could also look at the real wage growth. Right, there's been a minimum wage hike of about 6%, and again, you look at inflation, 3.4%. So it's interesting that in other countries, despite the fact that wages have been rising maybe 5.5% in the U.S., but the inflation translates to a negative growth instead.
In fact, post-COVID, we're probably up around 7-8% year on year right now. We had a little bit of a pop with the post-COVID. So,
yeah, and here incomes are recovering, because this is a discussion that we've had before. Wealth effect, income effect. And I think the bigger factor here is income effect, in the sense that jobs are starting to pop up again. That was closed up, in the services. Wages are going back to what they were before they were cut. People are now working full-time as opposed to lower hours. So I think it's that income effect. That's
starting to see headlines in the local newspaper about we can't get enough workers and this kind of stuff.
So Michael, here's a question that's coming into you. So, and we've talked about this as well. So, but depending upon the headlines, and I've even seen this even within Vietnam, depending upon the newspaper or the website, FDI is increasing, FDI is decreasing, more people are coming in, less people are coming in. Maybe just comment on how it's reported, because when we think about it, we think of FDI as one of the biggest trends, whether it's China +1, which will be a multi-year trend that hasn't slowed down. When you think about FDI reporting, what numbers should people be looking at?
Yeah, that's a great question.
Don't get too geeky on me.
No, we won't be too geeky. But I will say that every month when the statistics come out, we're going through all kinds of numbers, and look, the main number you want to focus on, which unfortunately is not really the one they talk about in the newspaper enough, is the actual dispersed FDI. So how much money actually came into the country. So in the first half of this year, the actual amount of money that came to the country is up about 9% year on year. And it's up, relate back to the tourism question, because it's easier for corporate executives to travel here now and actually consummate deals. There's another number that gets widely reported, which frankly speaking should basically be ignored, which is the so-called registered number. And
is that the promise of FDI?
Well, it's kind of the promise, but then companies will sort of say they want to do a project. It's like they're taking out an option. It's not really a reliable number. And then there's some other technical issues with it that I know you'll hate if I get into details.
So the answer is dispersed.
Dispersed.
Thank you.
Dispersed.
Okay, see, we just saved ourselves 10 minutes. Okay, here's a question. One of us is coming on the top 10 holdings, so maybe we can just talk about, because we have multiple funds, so it's hard to kind of answer that, but maybe talk about 2 or 3 of the favorite securities from the research team, the PMs, and why they're kind of fitting in the different themes.
Well, I think one of the companies that they all like is FPT. Is I guess the IT representation. IT here is about 1.8% of the VNI. But it's about the resiliency of its earnings. It's pretty much predictable, anywhere from around 20, let's just say mid-20% growth, and yet there's still potential upside coming from that. So in that aspect, there's growth, there's defensiveness. It's something that people can probably bank on. The second one is P&J, and it's about the recovery of income, especially on the high-end segment of the market. As I said, the revenue lines have been beating our expectations, and it seems to be quite resilient to any kind of inflation pressure because the people who are buying the jewelry are probably less susceptible to the inflation pressure. So again, the numbers seems to be trending higher, and this is a favorite not just for us, but I think for most investors here.
And I think, one of the things that maybe we don't talk about enough is, frankly, meeting with management teams and buying quality management teams. Because, VinaCapital, one of the things we talk about is we will not buy a company unless we know their management team well. And so when you think of FPT, you think of PNJ, you think of, a few of the banks that we own. I mean, these are firms that we've known for quite some time, probably 15, 20 years sometimes. And frankly, we know their management teams very well, and ultimately we're buying and investing with them.
Sure. I mean, that's one of the research philosophy. It underpins how we approach research, which is to focus on the fundamental bottom-up basis of a company. And management quality, where we kick the tires from boardroom to breakout room, and we repeat that process over and over again. That's something that we emphasize quite a bit.
Yeah, and again, kind of the whole boots on the ground, local
Yeah.
staff. Any new themes coming out of COVID? So we've talked about the return of income or the domestic consumption. Are there any other themes kind of post-COVID that are playing into the way you're looking at companies?
I think the biggest theme right now is still domestic recovery. Just because it's been there for a while doesn't mean that we should come up with a new theme. I think this has some legs. We're probably in the early stage. We're not even close to the mid-cycle or late cycle stage that we've seen elsewhere in developed markets. So I think that's the one that's going to keep pushing the market higher. You got to remember that 2/3 of GDP is still private consumption. And with the recovery of incomes and all that stuff that we just talked about, it's something that we just continue to focus on. If there's anything maybe longer term, medium to longer term, clean and green, we're up there. We do have our own ESG framework. We have our own ESG specialists. Clean and green from renewable energy, wind, solar, LNG. These are stuff that we want to focus on.
And a question just came in, what about mobile world? Still optimistic? There's still growth opportunities there?
Still some growth opportunity, mostly on the medium term. Yes, we saw the numbers. Yes, they were weaker. I'll have to admit, my analysts have had to cut down his expectations. I mean, if you read our numbers, it's probably more like 15% as opposed to maybe the 25 to 30% that he initially had at the start of the year. But again, on a medium to long term basis, we do like the company, but it goes back to the management. And I think part of the reason why the numbers have been pared down is perhaps in terms of expenses, whether it's going to be marketing or expansion plans. It's one of those things that you have to have a medium to longer term, not just about the short term. Short term keeps you there, but the medium to long term will probably make sure that it's a more viable investment in terms of a real portfolio.
And launching all those new formats, costly, but the long term is, I mean, you go out to the countryside, it's literally the only good,
Well, it goes back to that trend, the modern retail
Yeah.
that we've been talking about for many years. They're playing right up that alley. So you can almost forgive them that, okay, yeah, there'll be some bumps, short-term bumps, but longer term, yeah, it's probably the right thing to be doing.
Michael, a question for you. What is there potential for food inflation or any kind of Ukraine fallout?
So Ukraine, no. We published some reports on that. You can find on our website a very small contribution to the imports here.
That's mostly because it's not grain related.
Mostly because it's not grain related. Here it's rice is the thing. Now food inflation has ticked up from about 1% in toward the beginning of the year. Now we're running at about 2%. There's some very technical, geeky things that I know, again, you're not going to want me to get into, but specifically, we had the African swine fever epidemic here hit a year ago. So we're coming off of the pork prices went surged, and now if you look at the year-on-year comparison, we're down about 20% or so. Something similar with rice prices. If you strip out rice and pork, food price inflation in Vietnam is probably around 6–7%, so it's already high. Those year-on-year comparisons of the drop in pork prices, the drop in rice prices, will kind of wash out as the year progresses. So by the end of the year, we'll probably have food price inflation of about, call it 7% or so. Yeah.
Interesting. All right. Well, we're now at about 50 minutes, which is probably kind of 5 minutes more than we usually do. So we're trying to keep these to kind of 45 minutes to an hour. I'll just kind of say, kind of any closing comments as we think about the disconnect between strong economics and, frankly, not so great markets. What is your prediction for the second half?
Well, the Main Street, Wall Street disconnect exists here, except it's going the other way around. Typically, you say that when Main Street is doing poorly and the stock market is doing well. But here it's been reversed, and I think it's going to be still quite volatile. The risk out there is still fraught with uncertainty, whether it's going to be the global factors that affect inflation, such as oil commodities, or what's happening to the Russia-Ukraine war. But I think the down leg, maybe another 10 to 15% as far as the U.S. is concerned, which has a spillover effect to Vietnam, will probably have to come to that day of reckoning. If Mike has been saying that a recession is probably due, or there's a high likelihood it comes, the market's correct, then people are watching the Fed. The world is beholden to what's happening there, and if they stop the hike or suggest that they may not be as aggressive, that would probably be the reversal of fortune as far as markets globally is concerned.
So, okay, but I'm going to hold you to something. So I read this morning, so it's likely that the Fed will do 75 basis points at the end of July, maybe 50, but you think 50? 75, 50?
I mean, we're in a recession right now.
Okay. So
Atlanta Fed said we're in a
okay,
recession.
so if they do 50 or
Yeah.
75 the end of July,
Yeah.
you're thinking that may end in the summer,
Yeah.
and then in the fall,
They
that's
stop.
when you think you'll get a recovery.
Yes. Yes,
September.
and the China and Vietnam
September 12th,
stock
which
markets.
day?
I mean, if and when the Fed kind of stops this, what they're doing, these markets are going to rip higher. It's going to be really an epic rip higher.
Okay, so that we'll put that in the report card
Yes,
for September.
absolutely. You can hold me to that.
Rip higher.
Yeah.
So I guess the next one we'll do will be the first or second week of October. Actually, yeah. So we'll be doing our investor conference then. So hopefully we'll see some of you in person. So if we didn't get to your question, I apologize. Please send me a note. I think we got to almost all of them. Again, on behalf of the firm, thank you so much for joining us. And if you have any follow-up questions, please let us know. And we look forward to seeing you in the beginning of October at our Q3 wrap up and outlook for the remainder of the year. Thank you again.